Go ahead, Ken.
personal property, they would talk about, flooring, cabinetry, countertops, partitions, things of that nature. So, and that's just a few examples, but there's much more than that. So when we do this reclassification and we speed up the depreciation on those types of assets, and you're doing an exchange, then it's important on the new property that you're going to have an equal or greater amount of similar property. And how are you going to know that? Well, then generally the answer to that is you would need to do a cost segregation study on the new property or look for a property that had one done on it. Because if there's a delta, then that's where you run into issues and you could have a tax liability because you're not taking on as much personal property as you did previously. So that's one concern that happens. The second problem that can arise is that if the building improvements, you do the cost segregation study and those improvements are again reclassified, and then you sell the property's gone up in value, maybe the personal property items have gone up in value as well, then you could trigger recapture, which would be taxed as ordinary income. So that's something to keep in mind as well, that you could be faced with. So really, the problems can be twofold. But again, this really only comes into play if you're selling a property that had a depreciation study done on it. If you're selling a property that did not have one, and you just exchange into a new property, whether or not you do a depreciation study on that, you'll be unaffected.